Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So I know there are a lot of new investors watching the channel and a lot of new subscribers that are experienced investors on this channel as well. And all of us tend to make mistakes from time to time. And with newer investors in particular, I see a lot of common themes with the same mistakes that have been repeated over and over by a whole bunch of different people. So I want to spend this video going into my top 10 beginner investing mistakes. I'm going to make it short and sharp for each because I don't want this video to be 2 hours long or anything. But if there's any of these that you want me to cover in a little bit more detail in a separate video, feel free to drop them in the comments down below. And if you've made any of these mistakes or there's anything you think I've missed, feel free to also drop them in the comments below so that we can all learn from each other. So without further ado, let's get straight into it. Here are my top 10 noob investor mistakes. So the first mistake, and the biggest one that I see a lot of investors make when they first getting started in the stock market, is going in with the mindset of trading shares rather than buying businesses. So a share is simply a small piece of ownership in a business, and the way that you should make investments in stocks and publicly traded companies is by treating them as businesses. So I see too many people go out there, look at what the price action of a stock has been doing. Has it been going up? Has it been going down? Making a decision from that rather than spending time looking at the fundamentals of the business, because that's largely what's going to drive your return over the long term. Is the business producing a large amount of cash relative to the price they have to pay for them today? Or are they losing a lot of money? They're continuing to raise capital and add more debt and all these different things that are generally bad for business owners. Those are the things you should be paying attention to rather than, what direction do I think the stock is going to move. Really, we should be looking at how the business is performing and what price we have to pay for that cash flow in the business. So that's mistake number one, and that ties in quite nicely to mistake number two, which is chart watching. So this is something I was very, very guilty of when I first got started investing. One of the major factors I used to consider when I very first got started was I would look up a particular stock chart on Google. So I recall from memory, for the New Zealand investors, they'll be familiar with a company called Mainfreight. So I literally was searching up Mainfreight stock. I'd look at like the 5-year chart and I'd see that it had just gone basically straight up for 5 years. And the way that I interpreted that information was, well, Mainfreight must be a great investment going forward. It's continued to go up steadily over time, so it's probably going to do something like that in the future. So that is not necessarily what can happen to most stocks. Like I say, it's important more so to look at the business and how the business is performing, whether you think you're getting a good deal when you buy ownership in that business versus just watching the chart. The way that the chart has done in the past and the stock has done in the past doesn't indicate how that stock is going to perform in the future, and vice versa. If we've got a stock that has gone down a lot, the previous version of myself when I was first getting started would have just thrown that in the garbage instantly. Now that tends to be a stock that I actually pay a little bit more attention to, because there's a much better chance when a stock is beaten up that I can find a really good deal and we're able to acquire the cash flows in those businesses for a cheaper price than we might have been able to a year or so or 2 years ago. There's often very good reasons that stocks go up or down, and often they do deserve that pricing. But it shouldn't be the only factor that you look at when you're investing in the stock market, that is for sure. So that's mistake number two. Mistake number three is something I call chasing dividend yield. So I know that a lot of new investors really like the idea of dividends. They see that the stock market, in terms of the prices of shares, can fluctuate a lot, and it can be nice to just have cash coming in on a regular basis from dividend payments. So that is where a lot of people really like to put their money, is into stocks that pay high dividend yields. But you can certainly fall into traps when you're purely focusing too much on the dividend yield and you're not focusing on what's happening, like I said in some of the earlier points, with the rest of the business. So a great example of this is a company right here in New Zealand called Air New Zealand. If you were to look at Air New Zealand, say a year ago, they were trading with right around a 10% dividend yield. And the reason they were trading at a 10%, trading with a 10% dividend yield is they'd had a pretty good year. So the airline business, in my personal opinion at least, fundamentally is quite a poor business. You have a lot of factors that aren't very friendly for business owners and investors, which is very high capital expenditure. You have a workforce that's largely unionized. You have a lot of competition, and your pricing, you're essentially selling a commodity. There's a little bit of an element of brand power. So here in New Zealand, we all know that you'd much rather fly with Air New Zealand than you would with Jetstar, for example. But if Jetstar is able to offer a flight at one quarter of the price of Air New Zealand, there's no way that Air New Zealand are going to maintain those prices. So to a certain extent at least, your prices are largely determined by your dumbest competitor, as Warren Buffett would put it. And all of these things can result in very poor returns for investors. So the final big one that affects all airlines really is the price of fuel. So airlines are highly levered to the price of fuel, and if oil prices fluctuate even a little bit, they can go from being extremely profitable to losing a lot of money, or they can go from losing a lot of money to be extremely profitable all of a sudden from changes in fuel prices. And what we saw about a year ago is Air New Zealand had a really good year, so they paid out a lot of money in dividends, and that's when that 10% sort of dividend yield turned up. If you'd invested in Air New Zealand at that point, you would have lost a lot of money. So obviously not a lot of us could have predicted, or none of us could have predicted the current pandemic that's going on around the world, which has impacted Air New Zealand's business quite dramatically. But nonetheless, you end up getting dragged towards these largely lower quality businesses from an investment perspective when you focus too much on dividend yield. So that's largely the point there. Don't get carried away with just chasing dividend yield. It can make a lot of sense for companies to keep their profits and actually reinvest them in expanding and growing the business, which can return cash to you through share price appreciation. So that is mistake number 3. Mistake number 4 is selling a stock because it goes down. So this is one of the reasons that we have stock market crashes, as people get very emotional and they think that the momentum and the price of the shares going up or down in the short term is going to be extrapolated into infinity. So on one hand, we have bubbles getting formed because prices keep going up. People get attracted to those prices going up, and if prices continue to go up from there, they all think they're geniuses. It attracts more people and more people and more people, and you just get to stupid valuations. The same thing can happen on the other hand. So people can sell out and sell out and sell out of stocks, forcing the price down. Can scare a lot of people. They don't want to lose more money than they already have in stocks, and so they sell out at really low prices. And the way that you should be thinking about it, in my personal opinion, is firstly, you shouldn't buy a business unless you think it's a good deal in terms of the cash flows you're going to get from that business relative to the price you have to pay. So think about it like buying a rental property, for example. If you want to get a 10% cash flow yield on a rental property, you can work out pretty quickly what kind of price you want to pay for a rental property. So if nothing had changed, say 2 years later after you'd bought that property, you're still producing the same amount of rent and getting your 10% cash flow yield, and then someone came and offered you 20% less than you actually paid for the house to take it off your hands, there's no way you would sell to them. So that's the way I like to think about stocks as well. Think about them like businesses, like real hard assets. And don't get scared just because a stock has gone down. There's definitely reasons to sell a stock if it has gone down, if the business fundamentals have changed dramatically and they've changed to the downside worse than the share price has changed down. There's definitely an argument that you might want to sell in certain situations, but largely, if the business is unchanged and your shares drop 5%, that can scare a lot of beginner investors, and it's just simply a silly idea to sell because that happened. So that gets us into mistake number 5, which a lot of people might not agree with me on this. If you're a shorter term investor, you probably won't. If you're a long term investor, I really hope you do agree, because otherwise you're probably not a long term investor in my books. But number 5 is the use of stop loss orders. So for those that aren't aware, a stop loss order is basically an automatic sell order that you can put in with your stockbroker. And essentially what happens is you can say, if a stock ever goes down to this price, I want you to just automatically sell it and kind of cut my losses, so that if it goes down further, I won't continue to lose money. That, in my personal opinion, is a very poor way of thinking about stocks. If you're thinking about it in terms of needing to have stop losses, you're not thinking about owning shares as owning a business. You're thinking as a trader, someone who's looking more at short-term fundamentals. So not too much more to say on that one, but I think stop losses are a giant mistake. Buying shares and having them go down a little bit, and selling them can obviously be very bad if after that point they go up and triple, just like your original investment thesis had that doing over the next 5 or 10 years. So that's my thoughts on stop losses. Mistake number 6 is largely tied into mistake number 5, and that is having a short-term mindset. So with a lot of these mistakes and a lot of these points, you'll see that they're largely related to focusing on the short term. And I think it's pretty clear that the best investors in the world focus on the long term, and that's the only thing really that you can predict with any degree of certainty. So there's simply no one on the planet, in my personal opinion, that can tell you where the stock market is going to be at in 2 or 3 months' time with a high degree of accuracy, and do that over and over again. There's a lot of people that can tell you where the stock market is going to be in 20 years. And in most people's opinion, the stock market is going to be higher in 20 years from now, because the world is going to be more productive, and corporate profits are probably going to be higher than they are today. Just like we've had in the last century, we've had some growth in that. Dramatic growth, of course. So that's something you can predict, and you should focus on the knowable and not the non-knowable. So being a long-term investor is a very large part of that. Mistake number 7 is focusing on what the stock market is doing and not what the business is doing. So already mentioned this a little bit, but what I really want to get into here is trying to rather than watching charts like we were talking about before, this mistake refers more to trying to have an opinion on what the entire market is going to do. So we get this question all the time, what do you think the stock market's going to do? Because of what's currently going on in the world, do you think it's going to go lower? Do you think it's going to start to bounce back because it's gone down so much? And like I just said in the previous point, literally no one knows. So all we can do is focus on the long term, buy businesses where they make sense, and you can buy them at appropriate prices. They're well run, they have good competitive advantages, all those things, and basically forget about the rest. I really don't believe that anyone can make accurate market predictions over the long term. So mistake number 8, this is going to be a little bit of a strange one. So I often see in videos like this, people will mention not to copy others. Don't buy a stock just because someone you know is buying it. Don't sell a stock just because someone you know is buying it. This mistake, I am going to reverse that slightly, and I think the mistake that a lot of people make is actually not copying others. So that doesn't mean go out and copy your neighbor or copy your colleague at work who thinks they are really good at buying and selling shares and all these sorts of things. I think we live in a world, fortunately, where we have access to the best investors on the planet, and we have access to what they're currently buying and selling in the form of a 13F. So if you don't know what a 13F filing is, basically popular investors in the States, if they're managing more than $100 million, they have to disclose every single quarter what they're buying and selling. So that allows us to literally go and look at Warren Buffett's current portfolio, at Mona Sprabai's current portfolio, at Guy Spears' current portfolio. And there's several studies out there showing that if you simply just copy what they're doing, you will do quite well. So that's the mistake that I think a lot of people make, as they try to have unique ideas, and really deeply undervalued stocks are difficult to find. And if you find something in Buffett's portfolio that has been added relatively recently and to a significant scale, You've had Warren Buffett sitting there as your unpaid analyst in Omaha, willing to put a lot of his own personal money into it. So you can't get much better in terms of stock selection than that. So mistake number 9, we have our second to last mistake, is having an opinion on every single stock. This is something that catches a lot of people out, experienced investors, beginner investors, everyone. Is thinking that if someone asks them about a stock, they have to have an opinion on it. And I personally run into this a lot in my personal life, just because, you know, people know that I like to talk about the stock market and all those sorts of things. So I'll get asked about a lot of obscure companies that I've never heard of, or you know, I might be familiar roughly with what the company does, but I really haven't studied it deeply. And I think a lot of people feel some sort of obligation, just because they're into this stuff and into this world, that they have to give you a really good answer. And it's a little bit like being a builder. Let's go back to the real estate example. Let's say you live on a certain street in your town, and you happen to be a builder, and someone in your family asks you, you know, what's the foundations like on that house that's 10 houses down the road from you that you've never been inside or never had a look at. There's just no way you can know, even if you do have the ability to maybe figure that out if you spend a little bit of time on it. If you've never looked closely at a business, you don't have to have an opinion on it. If it's in an industry you don't understand, you don't have to have an opinion on it. Fortunately, we can watch pitch after pitch go by, as Buffett would put it, and we don't have to have an opinion on everything. We can wait till there's something we really understand, and then makes a whole lot of sense at the current price, and then we can put some money to work from there. So mistake number 10, and our final beginner investor mistake, is simply trying to get rich quickly. And I think I've probably hinted at this right throughout the previous mistakes. Long-term investing is the way to go. If you try to focus on the short term and focus on specific metrics like dividend yield and all those sorts of things to get a really good, you know, cash payment in the first year you own a stock, but after that it doesn't go that well, you get pulled into a lot of traps. And frankly, if you try to get rich quick, you're probably going to get rich slower than the guy that just tried to invest for the long term and buy and hold good businesses. It's a turtle in the hare type thing. So that's my final mistake. I do have actually one bonus mistake, so number 11 mistake that I see a lot of beginner investors make, and that is, of course, not subscribing to the Investing with Tom YouTube channel. So hit like, hit subscribe if you did enjoy the video. Drop any comments below on mistakes that you've made in the stock market. Love to hear from you. But otherwise, I will see you in the next one. Cheers.